Hi. As we started 2021, many people are wondering, well, what's happening around the world? What's happening in COVID? What's going to happen with interest rates in the US and the world? And what's going to happen within India with the budget and interest rates and inflation within India? And therefore, what should we be doing? Well, I think some of the lessons that we've learned in 2020, if you ask me, have been, things that we should be carrying on for 2021 and beyond. And what 2020 showed us is that it would be better to be across asset classes than to be in any one asset class. So what I'm saying is from my experience, it's not advice for you to follow blindly. You should, of course, listen and you should talk to your financial advisor and think of your own situation and figure out where things are for you and then plan accordingly. So with that disclaimer, let's go back to this chart that we've discussed before, that over the last 15 years, no single asset class has dominated the annual returns chart. Gold has done well 6 times, equity, as you can see, has done well 7 times, and bonds have done well twice. This is all for India data, but it's true for across the world. If you looked at the world market charts, it will be something similar. Some years equity has done very well, some year bonds have done very well, and some year gold has done very well. So what this tells you is that you should actually keep your money, invest your savings across different asset classes. And what COVID has taught us and what the great financial scandal when Lehman went bankrupt in 2008 has also taught us, that you should position your portfolio where you plan for growth, that you prepare for uncertainty, and certainly you prevent any shocks to your lifestyle and to the way you live. That's important. So let's just look at some very annualized data for what happened in 2020. Again, I'll talk about the quantum mutual funds because I do not invest in individual shares of listed companies. There's a lot of compliance reporting for me. So I build my portfolio largely around what I do with the quantum mutual funds. Of course, groups like Personal FN will tell you which mutual funds to buy or subscribe to or invest in besides the quantum mutual funds. And Equity Master, another company which I helped create, will tell you which individual stocks, whether small cap or mid cap or large cap, should be purchased if you wish, if you feel they are right for you. So you can either choose individual stocks, you can choose a range of mutual funds from Personal FN, a separate company, or of course, doing what I'm doing with the quantum mutual fund complex. This is what I've been building my portfolio. So the quantum liquid fund, kind of steady, a little bit of a blip, as you can see in 2020 March at the time of COVID. Of course, it did much, much better than many other liquid funds, but there's a bit of uncertainty there. And then, of course, when things carried on in terms of liquidity by the RBI, etc., the returns kept on increasing very steadily for the rest of 2020. And the quantum dynamic bond fund, which you can think of a little bit of spice if you want to add some more risk. And you also obviously expect a higher return whenever you take more risk. The quantum dynamic bond funds tries to position itself on changes in interest rate movements. And therefore it buys sovereign bonds and quasi-sovereign bonds. And sometimes a fund manager will buy a 7-year bond and an 8-year bond, and then he may move it to a 3-year bond because he's playing the interest rate cycle. And if he's smart and if he's good, then of course you get a little bit of higher return than what you would in a liquid fund. And here again, you can see, of course, things happened around March, April because of COVID and shocks to the global capital markets, including in India, and then the recovery phase. And the quantum dynamic bond fund has done very well, giving you nearly 10% rates of return for 2020. Moving to the long-term equity value fund, this is, of course, it's much higher risk because you're investing in stock markets. And you can see what happened in March, April. At the time of COVID, stock markets fell very sharply. And clearly, even the quantum long-term equity value fund declined sharply. And then when markets recovered, quantum long-term equity value fund also did very well. But the style that it follows, the value style, generally does not do well in frothy markets. When people are berserk and they're buying expensive stocks and don't care about valuation, it is unlikely that the quantum long-term equity value fund will outperform the peers or outperform the index, because at that point in time, it's trying to take risk off the table and trying to be in less expensive or lower PE ratio stocks. Then moving to the quantum equity fund of funds, an extremely interesting product from the Quantum Mutual Fund Group. Again, I am the founder of that, or helped create Quantum Mutual Funds. So no bias there, but honestly, it is, I think. What we've done in Quantum Mutual Fund is looked at other fund managers in other fund houses and tried to see what styles of investment they follow, whether they're large cap or mid cap or small cap or growth, and then create through a basket of buying different funds, 6 to 8 funds, you create a basket for an investor to buy. So a person who's investing in quantum equity fund of funds is actually not giving quantum the money to manage directly. It's a pass-through vehicle, and the money that you invest in quantum equity fund of funds will land up on the laps of 6 other fund managers in different fund houses, managing different styles, and quantum equity fund of funds, along with PFN actually, who does the research for them on which funds to select, will give you this exposure to different styles of management. So in the past, I've called this as different paths to attaining nirvana. So the quantum long-term equity value team believes value investing will give you good returns and give you the investment nirvana. And these fund managers within quantum equity fund of funds selected by quantum team will give you nirvana in their own styles of managing money. So all paths lead to God. There may be different religions, in a very similar way, all paths should lead to sensible long-term returns. And by having this combination of equity fund of funds and those funds managed by the quantum fund managers, you'll end up with a good basket and a good diversified basket of underlying stocks to help you achieve your investment nirvana from the equity bucket. Moving on to the Quantum India ESG Fund, this follows a very different style and was launched by Quantum in July of 2019. So it's just about a year and a half old, and it focuses on what's now being called planet, people, and profit. So what Quantum does is through their own proprietary database, they select those stocks in the Indian list on the Indian stock exchanges, which are achieving a certain score in their proprietary ESG scoring system. And then based on the score, you either get a place in the portfolio or you're not in the portfolio. So any stock which has an ESG score of 0 plus, above 0, can find its way in the portfolio, and those that have a negative score will not find their way in the portfolio. And they don't look at valuation. So unlike the value fund manager, who's worried about price to earnings and price to book ratio and price to cash flow and earnings growth, here they're only focused on, is this company what is called sustainable? Are they responsible? And the thesis being that the more you worry about the environment, the more you worry about your own internal staff, the more you worry about society, and the more you worry about your customers, so the planet, people, and profit, then you will actually be a good enterprise and you'll always make money. So that is the theory of the Quantum India ESG Fund. And as you can see, like the other equity funds, it fell sharply in March, April, and recovered very smartly and has done very well in the recovery phase of the stock market in 2020. Moving on to gold. Our views on gold are well known. We believe it's an insurance, and it did that. As you can see, when markets fell in March, April, yes, it did decline, but did not go to negative. And then, of course, when there was still uncertainty in the world, it picked up speed. And even though equity markets have done very well, and there's some semblance of normality in the world, the Quantum Gold Savings Fund, based on the price of gold, has actually done pretty well for the year 2020. It's off its highs, but it's still in the plus region. And given where central banks are, given the printing around the world, given potential fears of inflation that could creep up around the world, gold prices, we believe, are likely to go up, and gold should find always a place in your portfolio. So if you put all the quantum mutual funds in one graph, so the gold fund is right on top, and then the three lines at the bottom, which fell very sharply, March, April, May, are the equity funds. And then you can see the ESG fund doing very well, pulling away from the pack, if you will, and then the long-term value fund and the equity fund of funds, the red and the green, have also had a good year. And in between that, you have the bond fund, the quantum dynamic bond fund, which gave you that nearly 10% return, and the quantum liquid fund, which you really buy for safety and for you need the money, so you make sure that it's available to you when you want it. You don't really care about the returns, and that gave you a 3.5%, 4% rate of return, as we showed earlier. So given all of this, what exactly is it that we're trying to build out here? And I think that if I can just go back to the charts a bit, I apologize. If I can just go back to these charts over here. So you would not know what to do on your own in some sense. And you have to decide which fund to invest in, how much to invest, when to switch around. And here, in fact, if you're so confused, there is actually a one-stop shop solution from Quantum Mutual Fund, which is you don't have to worry about how to switch money. When do I buy gold? When do I buy fixed income? When do I buy equity? When do I reallocate, etc., etc. They have, if you've got a long-term horizon, time horizon, then Quantum has a solution for you, and that solution is the Quantum Multi-Asset Fund. So it's one fund. It takes care of all asset classes, and as you can see, it has equity in it. So when markets fell in March, April, when stock markets declined, of course, the multi-asset fund has stocks in it, so it also declined. But it did not fall by 20, 30% like stock markets did. It fell a lot lower because it has gold and it had the bond funds, it had the liquid fund. So therefore, it had protection on the downside, which is what gold and the liquid fund provide. And then when the markets recovered, it did pretty well because again, it had the equity in it and it recovered, and that was it. So in the course of a year, it gave you a decent return of just above 13%. But of course, it did not fall as sharply as the equity funds fell. Let me just go back to the slide. And you can see how the equity funds fell 30%. Now, if you don't have the stomach for a 30% fall, right? If you're just holding equity funds, by having this diversified solution of the multi-asset fund, you're capturing the upside when markets do well, but you're also limiting the downside, and you're not worrying, by the way, how much money should I put today in equity? How much should I put in liquid fund? Are interest rates going to go up? What's going to happen in the budget? The fund manager of Quantum Multi-Asset Fund is taking care of those allocations based on his experience, based on her experience, based on their experience, and they're making those decisions for you. So if you still want to do things on your own, as I have done, you want to use the building blocks of the various quantum mutual funds and to build a portfolio that works for you, then maybe this is another solution that you can look at and consider. And as you know, I've been talking about this for the last year and started this in 2008 at the time of the great financial scandal when Lehman went bust. So I did it very simple. If you assume that there's a savings pool of 20 lakhs, and let's assume that you have expenses of 50,000 rupees a month. So one of the ways to protect yourself, to plan for any COVID-like crisis or any Lehman-like bankruptcy crisis which shook the world in 2008 and 9, is to keep 24 months of your expenses in a safe place. And that's about 12 lakhs rupees, right? 24 months into half a lakh a month is 12 lakhs rupees. What are those safe places? Well, 3 months of money in a bank account. So 3 into 50,000 goes in a bank account. And that's your savings account, your current account. We know that banks have not been the most solid places to put your money. So you don't want to put that 3 months into an FD, you just want it liquid. When you need the money, it's there. And then 21 months in a liquid fund. So that would work out to roughly 10.5 lakhs rupees. So your 12 lakhs is split between bank account, 1.5 lakh, and 10.5 lakhs rupees is spent in the liquid fund. You saw the track record of the liquid fund. It's steady, it's boring, you're not going to lose money in it, but you won't be making a lot of money either. It's there as safe money when you need it. That's why it's called a liquid fund. It's available for you when you want it. So that's your sacred money. Then the rest of the money I would classify as your investment pool. So if you again had 20 lakhs to start with, and you kept 12 lakhs away, that being the 24 months expenditure. So now you've got 8 lakhs of rupees working for you. And those are in investments for the long term, for the different needs that you may have, for your ambitions for yourself or for your children. And over here, 80% of that 8 lakhs, so roughly 6.4 lakhs rupees, you should put into equity funds. And how should you distribute that? Well, we showed you the equity fund of funds. 70% of your 6.4 lakhs, that's roughly 4.48 lakhs, should go into the equity fund of funds. The value fund may be 15%, so that's 96,000 rupees. And the ESG India fund, another 15%, that's 96,000 rupees. So effectively, you're buying three different funds, but you're getting 6 fund houses, or rather 6 mutual funds from the equity fund of fund, and the value fund, and the ESG India fund. So by buying 3 funds, you actually have an exposure to 8 different styles of fund management. 6 come from the equity fund of funds, 1 comes from the quantum value fund, and the other 1 comes from the quantum ESG India fund, also managed by quantum. So this 80% gives you the equity exposure for capital appreciation for the future profit that you would like to see as you achieve your long-term ambitions and goals. And then gold will be the other 20%. So 80% of the 8 lakhs is in equity, and 20% of the 8 lakhs, that's 1.6 lakhs, is in gold. And when you do this, you basically, I think, have built a fairly solid portfolio. That's what I've done. Now you can fool around with this, okay? You can say, well, I don't want to have 24 months expenses in safe places. I'm happy with 12 months, which means that instead of the 20 lakhs pool that you have and 12 lakhs you kept away, now you keep only 6 lakhs away. You break that up again, 3 months in a bank account, that's again 1.5 lakhs. And then the other effectively 9 months, which will work out to 4.5 lakhs. So you'll have 6 lakhs rupees in safe places and not the 12 lakhs rupees we've shown over here. And then again, the rest of the money, you can invest 80-20 in the same proportion as I've shown over here. Those are, you can play around with these things, but understand yourself, talk to your financial planner, talk to your CA, talk to your family members, get a sense of what you're trying to do, and then build a portfolio, which I think makes a lot of sense and has worked very well for me. And I'm very happy with that. So again, just to summarize, the portfolio that you're building should be such that you're planning for the future and you're preparing yourself that, yes, that things could be wrong and I won't be surprised. And if things do go wrong, you don't prevent a lifestyle change. You don't have a shock in the system, which disrupts the way you live because of a COVID crisis or the great financial scandal, a great financial swindle of 2008, 2009, etc. So just by doing this, you've got a summation in some sense of all these spaghetti line graphs that you're seeing, and you're doing it yourself. Or if you do it in the multi-asset fund, then of course the quantum is doing it on your behalf. So these to me are the very, very simple things to do. It's not rocket science. It's very easy to do this stuff, but it just requires the ability to sit back and recognize that sometimes simplicity can give you a wonderful solution. So thank you so much for listening in, and I hope you enjoyed this session and this